All right. Hi, everyone. Welcome to day 2 of the Analyze Your Trade event number 209 on TimingResearch.com. This is the first time we've ever done this series as a 2-day event, so this is exciting. We had a good day yesterday. And in case anyone didn't hear this, all the archives are available on TimingResearch.com. Also, if you search for Timing Research on YouTube, Substack, or your favorite podcast app, you can find all the recordings there as well. So just a reminder, all of these presentations are for educational purposes only. Trading is not suitable for all people. And please consult a financial advisor before you trade and only use risk capital for trading. So to start out today, we have Michael Katz of TradeThePool.com and TheFivers.com. And I'm going to go ahead and turn it over to him.
Thanks so much, David. Appreciate it. How you doing, everybody? Good morning. Before I'll start, let's get to know you a little bit, so I'll know how to take that the next 50 minutes and how to shift it to fit it to your needs, I guess. So just let me know if you trade in stocks, options, forex, futures, and how long you've been doing that. And we'll take it from there. In the meanwhile, while you're trading, while you're typing in the chat, the idea basically is for today's session is to go through the indices, try to analyze them, see what they have done in the last few weeks and months, and afterwards going into the scenarios of what we can expect again in the next few weeks and months. Depends on what you like to trade and how you do that. And obviously I will talk a little bit about risk management, which I really love to talk about and elaborate more, especially from my background that I'll share in a second. So continue to write down in the chat. Super important and interesting to see who's with me on the line. So I see Forex and ETFs. That's a nice combination. 20 years in the business. Nice. That's very nice. So myself, I'm Michael again. I've been trading for 16 years, mostly day trading equities. In the last 7 or 8 years, I joined also and traded futures as well. So a mix of both. You know, when I started to trade, it was kind of just as usual. You know, as a retail trader 16 years ago, there wasn't a lot of information online, and it took me a while to get where I'm at. After a few years, I became the head of the traders in one of the local prop firm here in my country. And then 2 years ago, I developed and basically joined or opened Trade the Pool, which is an online prop firm for equity traders. So that's like in short, right? So let's dive into the charts. Obviously, although I'm the CEO of Trade the Pool, I'm still trading like 80% of the time. I love to trade, and this is definitely something that I'm looking forward to continue to do, just because I'm looking at trading as a game. And you have the bad guys, like the smart money, you have the good guys, the dumb money, us basically, and we are trying to understand or maybe trying to win this game of trading. And this has always been fun for me, not just on obviously on a profit level, on money wise, but also just understanding the game and trying to solve it basically. So let's dive into that. Of course, if you have any questions, feel free to drop them in the chat. Besides that, if you have symbols that you want me to cover and analyze with you, so definitely do that too. And the first asset that I would look at is basically the NASDAQ, the NQ. I've been trading the NQ for many years. In the last 4 months, I took a challenge with our parent company, the Fivers, and actually took a 100K account and traded only NQ. I will share the results and some insight that we can learn from it in a minute or so. I uploaded everything to Trader Sync, one of our partners, and that's basically a trading journal that analyze your trades. So looking at the NQ, the idea was obviously super volatile in the last few years since always, but since the COVID, even more. And the idea is what I'm looking for is basically is buying the dip or selling the top. And a lot of the times I'm more short bias. So the nice move that we had in the last from December is actually it's a great move to the upside, but I shorted a lot of those movements, like those pullbacks. And even here, when we started the rally from around the end of October, also joined a lot of the time for the pullbacks, basically. So selling the top. The idea is, when looking at the chart, and maybe let's try to take a naked chart first. So when looking at the chart, the first idea that at least in my opinion is important is get rid of all the indicators, get rid of all the noisy stuff, right? I still have the MACD here and I'll explain how I use it. But besides that, try to look at the chart just as a price action, right? Because at the end, the indicators that you use in RSI, MACD, whatever it is, moving averages, they are all basically comes from, they all come from the chart, right? From the price, the open or close or high or low, and the volume for some cases, in some cases like VWAP indicator for intraday trading. So try to look at the chart and understand who's in control, right? You can do that by testing some levels. And let me go to the, let's take the daily chart. Or maybe at 4H, like a 4-hour chart. And that will give us some nice indication when the price is shifting. Because in my idea, and the smart money way that most institutional traders will go is basically try to obviously buy the bottom and accumulate the price while taking the long position. And when reaching the top to a major liquidity area, then that's the area when they actually looking to sell their shares, right? So in my opinion, we as traders, as I'll call myself a retail trader, so as retail traders, we want to imitate that, right? We want to trade with the smart money, with the institutional traders. So you can always look for breakouts or, break the price, break resistance or breakthrough resistance and go long and stuff like that. But if you're thinking of the other option, which is looking for support levels to buy the dip or looking for resistance levels to sell the top, that will give you a lot more edge, in my opinion, along the way. And I'll show you a couple of stuff that I did, and maybe you can relate to that, and hopefully it will help. So a few things that you can do in order to understand when the price should turn is, one, obviously mark the areas of liquidity. The market, as we know, moves through liquidity levels, right? Like a magnet, and goes up or down to liquidity levels. What I mean by that is that there are many traders, algos or manually traders that just put in their orders, right? If you're using, let's say, a Bookmap, one of our partners that shows you the liquidity levels, then you can easily spot where the market wants to go. And once it will reach that, you know that there are higher chances for it to stop there, because it goes down to a major support, right? Or goes up to a major resistance. So the idea is to build your trade around that support or around that resistance. Obviously, from time to time, it will break the support and your trade won't go as planned. But in most of the time, this support area, if it's the right one, and then it should hold. And if it will, then you got your trade. So for example, I'm standing, that's a classic one. Again, NASDAQ, 14,240, right? Exactly where I'm at right now with my mouse. And you can easily spot that support level, right? We had it once here. Then another round, just a tiny bit after. And after roughly 3 or 4 months, we reached that place again. So that could easily be one to mark. And the price, when it declines and reached that moment when it already tested that support, then it makes sense for you to go long. Obviously, it's just one parameter, and in most cases, to get to a position, you would like to see at least 4 or 5 parameters that actually approve your trade. But this is a great start when you're looking for an opportunity to long the NASDAQ and you're waiting for that moment to reach a major support, major liquidity level. And it's important to understand another issue here is that, as you can see, it broke it, right? And then it bounced up. Now, most traders will place their buy order at support, and once it will break it, then they'll be out of that trade, and basically the price will take their stop losses. But if you manage correctly the trade, you won't go in with a full 100% of your risk. So for example, you understood that this is a major support level and you should go long from here, right? We'll go into a little bit more details in a minute, but just to simplify, you looked for a major support level to go long. You found it on a 4-hour chart, for example, and now you want to build your position. Now, let's say I'm willing to lose $100 a trade, right? Instead of risking the full $100 trade just by one click, and my stop loss will reach in very fast, what I would like to do is break down the $100 trade into 3 to 5 sessions or clicks, right, or executions. So let's say I will risk $20 on my first execution, and then another 20 and another 20 and so on. In that way, I'm averaging, right? I'm averaging my price, and I'm giving the trade the opportunity to actually start and move to my favor. Because in most cases, when you click the mouse key, the stock, the ETF, doesn't matter what you're trading, in most cases, it won't go right away to your profit, for example, right? It will play around with it, maybe drop a little bit, and then only bounce from it. So in that case, when you put in basically scaling in and breaking down the risk that you're willing to take per trade, you're actually giving yourself the real opportunity to be in that trade, even if it will play around and try to take those stop losses, especially on the NASDAQ when we have many manipulations every single day of stop hunting and so on. So the idea is finding a major support level. Once we're reaching that support, you can easily go with a 20% out of your total risk. Like I said, the $100, now you're risking $20. Imagine the psychological aspect of it when you click in the mouse key and you know that you are willing to lose $100, but you only right now on the mouse key, you click in and risking only $20. It gives you a very relaxed approach to trading, because you know that even if it will go against you, you will only lose that $20, right? So it's automatically easier for you to execute the trade. I've been trading and teaching, and I've been traded with probably 1,000 traders at least during my career. And you always get those traders that just afraid to click the mouse key. And I'm sure some of you guys that listening right now having the same fear, right? Because you are basically committed to that trade and you're risking your own capital. So those kind of elements will automatically affect you, because obviously we all fear of losing money. So in that regard, instead of risking the full amount of money, just risk some of it, like 20%, and then it will be easy for you to commit to that trade. Does that make sense? Now, once we reach that level and I'm in with the $20 risk out of the 100, now I let it play, right? So it goes a little bit further into the level. I can add more to the position because I'm only risking $20 out of the 100 that I'm willing to lose. So even, let me zoom in for that. So let's say once it reached that support, the beginning of that support, I'm in with $20 risk. It dropped down a little bit more. I can add even here more, $20 again, because it's only $40 risk out of the $100 that I'm willing to lose. So I'm still way far from the moment that I will lose $100. Now that it goes to my favor and it broke to a new resistance, this like a consolidation move, I can add more to the position. If I will, if let's say we saw a nice move to the upside and then a retest to those support, I can add more here. And then I'm basically building the position instead of taking the full $100 risk here. And that's it. Once it dropped, I'm out, right? How many times you had this moment when you actually, you analyzed perfectly, you find the right stock, the right asset to trade on, you entered, a minute after, if it's day trading, a minute after you're out of the game, it took your stop loss 3 minutes after making a crazy profit if you would have stayed. I know for a fact that most of you guys experience that. I experienced that for many, many times, many years. So once you shift your trade management, you actually give yourself the opportunity to stay within that trade because you did your analysis right. You know, you had your charts, everything organized, you understand what you wanted to do, you have your trading plan. And now that you execute the trade, you just need to give the trade an opportunity to actually start working to your favor, right? So that's for support. Same area for resistance. Now it could be, let's take this one for example, because I don't like to give just the perfect examples. Obviously, the market doesn't work like this. So let's say you took a short, right? You saw a resistance, then you took that short. So here, when it reached that resistance level, you took one short with $20. Now it moved against you. It should go probably to here, if not more, in order for you to lose $100. And this, in those cases, I had a few cases in the last few months with trading the NASDAQ, taking short on the NASDAQ. When it actually broke through a new high, I took that short and it goes against me. But since I only risked the 20% out of the total 100, then I don't care. It could go much higher than where I started, just because I'm not risking the full $100 yet, right? So when it goes here, I'm down $45, $60. It's still within the range of 100. When it went here, I'm down $80, $90. So I'm literally getting close to the 100, but I can give myself enough space for basically being wrong on that execution, which lead me to the next step here. A lot of the times, you know, you will learn in courses that you need to execute perfectly, right? That you need to go right at the exact moment in the exact price. Once you will start working, as I just mentioned, and basically scale into your position, you don't really care about the execution part, like being right on the execution. I had so many trades, some of them live in the trading room with the Fivers, for example, that I actually took a short right at the bottom and it bounced right back up. But since I only took the 20% at the bottom, I could easily add more to the position once it bounced against me, because I had much space for my risk, basically. Let me know if you guys with me on that, and if you understand that or need a little bit more clarification. And we can dive in a little bit more to talk about more parameters that basically can just give you a little bit more of approval that this is the right setup, this is the right movement. For example, on the NASDAQ, you can take the last one. And again, I will share my my trades in a second, and we will go through them. For example, the NASDAQ went up from that support level, right? And as you can see, I'm always marking it not as a one line, but actually a rectangle. So I have an area of support and not actually one point. And that's super important, because once you have an area, then you can play and add to your position within that range, right? If I only mark it with one line, then I don't really know where I should add more to the position. So always mark the levels, especially when it comes, if you trade in big companies like large cap, you want to give yourself enough space, like the range to play with, and not just a one line. So let's say the NASDAQ, right? We had a very nice run from October, the end of the October, all the way to the top at the end of December. And you can see that the market is started to shift. We have few parameters to acknowledge that. Obviously, we broke through a new high, and we did a very nice run afterwards. But look at the chart. Let me zoom in a little bit. Look at the trends or the waves, right? You can see that the market broke through a new high, consolidated. Then the next one was a little bit different from the previous one. So the next one, we have this wave, and then another one here. So if you compare the waves, if you compare the trends, you can actually, or the rallies, you can actually see that the last one here is getting much more, like fading much more, right? Look at the angle of the movement to the upside. In most cases, not in this case, but most cases, you will also see a longer trend, basically. So it took it a longer time to reach X dollar or points, and you can see that the momentum of the guys that was buying at the bottom, were buying at the bottom, actually are getting basically fade to that move, right? Now, it doesn't mean that you will shift the direction completely and going into a bear market, obviously. But this one, I didn't hold it for that long. I actually exit right about here. But this move was, I wouldn't say easy, but it was a very make sensible, I guess, that we will see a pullback from here. Now, another thing you can add, if talking about indicators, is that you can look at the MACD. And for those of you not familiar, MACD is basically three EMAs, 12, 26, and a 9. So the MACD will be the difference between 12 EMA to the 26. And you also have the 9 as a signal line. But what I'm looking for is divergence, a negative or positive divergence between the chart and the MACD, right? So you can see that we are creating new highs right here. And afterwards, a new high, the market goes to a new high. But look at the MACD, it's showing us actually lower highs, right? You have one high here, the other one lower, and the third one is also lower. So the market goes up while the price or the MACD is actually going down, showing you a shift in the momentum, or actually retrace of the buyer's momentum, right? They're getting weaker. It doesn't all the time will tell you that the sellers will become stronger, but it shows you that the buyers are getting weaker. Okay, it's also important to understand, just because the buyers are getting weaker, it doesn't mean that the seller will actually become more aggressive. Maybe the seller don't want to push it either, and we will see like a consolidation or just a rangy move. But in that case, it will show us in most cases that the buyers are getting weaker basically, and some cases the sellers will take the position, right? You can see that we also had another one right here. So you have high and high, break to a new high, and this one is lower than the previous one. So the MACD goes down while the market goes up. And in that case, as you can see, it didn't work. You had a very tiny move to the downside, and that's it, consolidate, as we just mentioned. So sellers didn't come here and push the price down, although the buyers kind of got weaker. But basically, because the sellers didn't come, and then we just saw this rangy move until the buyer said, you know what, let me push one more time, right? So if you go to now looking at the chart, you will see many of opportunities like this, and it should, be easy to spot. High, a new high, and then look at the MACD at the bottom. You can see that the price or the MACD chart is going down while the market going up. Now, again, when you're looking at it that way, it's easy to spot it. But remember, and this is probably the most important thing, don't go to the MACD or the RSI or the stochastic before you have the chart, before you analyze the chart, understood exactly where the levels are and so on. If you only use the MACD or any indicator, it's a losing game. You got to understand the price movement before, right? So you can see what we talked about, like the trends and the waves getting weaker. Look at this. So this is one. We broke to a new high. And then the third one is actually getting weaker too. You saw it also here. We had that break, and then the third wave couldn't break to a new high. So try to, now that you're kind of getting familiar with it, try to look at the asset that you like to trade and try to find those elements. So a shift of the angle and the time of the trend, right? So try to compare waves to waves. Like in most cases, you will get 3 waves. So the first one is strong, the second one is okay, and then you got the third or the fourth that are getting more of a banana shape. Like the trend is getting more of a banana shape. So you see the buyers are getting weaker. Obviously, the same if you flip it and looking at a stock that going down. And also after that, try to look at the MACD and of course mark the levels, right? So once you have all that, it will be easier or simpler just to understand where it should go. After you have that, now you can go into the trade management and do what I just explained about just scaling and getting into a position not with a full risk. We can look at this example as well. You have that major support level, right? Resistance first, then became support. So in that case, once we're reaching this level, you can understand that this is your trade, right? This is the moment you can actually trade this. You also have a tiny diversion, a positive diversion. The price is going down, lower lows, while the MACD is creating higher lows. If we would go down to an hourly chart, maybe the MACD will be a little bit more nicer. But basically, you're reaching support, MACD diversion, volume coming in. If we will look at a 1 minute chart, you will see a major volume coming in at the support level. And basically, this is your moment to jump in and do your thing. Trading, manage the trade while you're taking 20% risk first, add into that position, and then only then add more to the position, and potentially it will go to your favor. Again, if it would have done a drop like it did here, then that's totally fine. You add to your position, it dropped, you're out of the game with $100 loss, or maybe even less than that. Of course, for some that mark that level as well, this is a bit more trickier, but the concept is the same. So for example, you took a long here, right? When we reached that support, only $20. It dropped down to the next level. Now you're minus 40, let's say, because you only took a $20 risk. Now you minus 20, because let's say $20 risk would be here, $40 risk would be here, or $50. Now you added more to your position, right? You are basically with a total loss, if it goes against you, with a total loss of $80. You're still within the range that you're willing to lose, the $100 that you're willing to take. So in that case, you have one buy here, the second one here, your average price is roughly here, right? And then you have the nice trade to goes to your favor. As long as you give yourself that opportunity, if you did your analysis right, and you give yourself the opportunity to really have, to give the market a chance to prove itself, then in most cases, you will have a winner there. I'll go through some of the stuff that you're writing in the chat. If you have more, feel free. And afterwards, I'll go into the trading account and show you some of the stuff that I did. And we can analyze them and understand what exactly I did there. Okay, so the MACD we did. Nice, Christopher. Try to do that. We'll go, we'll look at a couple of stocks, couple of symbols, sorry, later on. Find support level, go long, partial entry. When do you add to it in day trading? Okay, so basically what I'm doing, Tommy, is analyzing it on the hourly chart. Let's say the Nasdaq, analyze it on the hourly chart, and then goes in and basically wait for the day, for the intraday. Now, let's say, let me take a 1 minute chart. This is in most cases what I'll do. Let's okay, let's just mark it like it is. Okay, so let's say this is a major level from the hourly chart, right? I'm on a 1 minute chart, but let's say this is a major level from the hourly chart, 4 hour. That's fine. I'm waiting for it to reach that support, right? $20 risk, 20%, let's call it. 20% risk, I'm here. It dropped down below. Now I'm not risking 20. Let's say $20 risk is here, right? Now it's dropping down a little bit more, but I'm risking again only 20 out of the 100, right? So here, if this is the range, basically, I can easily add more to my position here. Why I do that? Because I'm not risking more than $100. That's the, we call it the trick, right? If you're risking not more than what you're willing to lose, then you're totally fine. You can add as much as you want to your position, even if it goes against you. And I know there is a myth, or guru YouTubers will talk about not averaging down and stuff like that. You can average down as long as you are within the risk parameters that you set before you enter the trade, right? If I'm risking $100, I can easily, and I'm taking $10 each time. I'm clicking the mouse key and risking $10 each time. I can easily add to my position, my losing position, because it's within the range of $100. I hope it makes sense. This is for me a wonderful solution for you guys to test, at least. You know, give yourself a week or 2 weeks that you test in it. I'm sure you're gonna see a huge change, because our funded traders doing it every single day. And once you understand that trick, it's easier for you, like I said, to commit to that trade and act not on the emotional part, but actually on the logical aspect of it. So $20 here, another 20 here. Now I'm down, let's say, $40 or $50, bouncing again to my favor. If it breaks through that range, I can add more to the position. So that's another 20 here. If it goes again and test the level, I can add more. So let's say it was here, added another more, waiting. And now when it breaking through that, I can either add more when it pulling back or breaking through a new highs and so on. But that's the concept. Now, in most cases, what I would look for is also a diversion in the MACD on the intraday level, so a 1 minute chart, and look for higher volume at the bottom while reaching support, right? So in that case, this is the opening bell and the pre-market. So obviously we got a big change here, but you can see high volume coming in here once we reach that so-called support. We can go back and see if it's a real support, but this is basically the idea. Okay, amazing, Christopher. Yeah. Why didn't that influence? Where is that, Ekne? Can you give me the date? How do you asking how do you know support resistance will work? So first of all, support and resistance in a general matter or on a philosophical level, they work, right? We know they work because that's liquidity. This is where the market wants to go. It's always going to the next order, right? So, and this is why I love so much looking at the chart, because it's kind of easy to spot where was the next resistance or the next support level. So you just look at the chart. This is the resistance. You go right. You see that it acted as support. Now you can understand that in most cases, you will get support here. In most cases, not all the time, but in most cases. Now you can build your scenarios and trade management according to that, right? It should be simple. It should be easy to spot. If you're trying to mark levels that only you can see them, then this is probably not it, right? You want to go to the simplest way and just look at the chart like a naked chart. Try to understand, okay, this is a major resistance, right? This area right here was resistant. Just taking it even before watching this area, just take it all the way to the right, even before we saw that, and you can understand that you will have some action here. It doesn't, as you can see, it doesn't necessarily mean that the price will drop right away. And as you can see, it broke through that. I actually took a short here and added more as it continued against me, and only then had a nice move to the downside. So like I said before, if you enter in on a smaller chunks, then it's easier for you to give a space and be basically wrong on your trade and still make money on it. Tommy, in regards to partial exit, I will do basically the same. I will mark the next levels, and once I'll reach those, I will start taking some out, 20%, 30% out at first, and so on. Of course, while the price is going to my favor, I can try to understand if there is a strong momentum to the downside, and I can hold it just a little bit more, or this is just a tiny pullback and we're going to have another move to the upside, so I can take more of that partial out. Christopher, you're saying adding on the way up, or since you are risking 100? Yeah, exactly. You can basically add more on the way up because you're risking that $100. Now, let's say, okay, let's take again this example, right? You know that yours, oops, sorry. you know that this is your support level. And let's say you added here, in this case, and it continued to drop against you. Now, since you don't really have a level, a strong level behind it, like below it, hold on, right? The next support level, let's say it's right here. Major support level, it's here. So you know that there is no reason for you to continue and lose the full $100. So let's say you added here, you're $20 in a loss, it's dropping against you. Now you said, okay, the next major support level is here. So it doesn't make sense for me to lose the full $100. And this is also, that's a great thing that you mentioned, Christopher, because this is also a way for you to basically lower your losses while trying to push to the with the winners, your profits. So in that case, instead of losing the full $100, now you cut in your loss with a $50 because it doesn't make sense for you to hold the position all the way down. But if there was a nice support area here, then you said, okay, that's fine, I'm down 20. When it will go to the next support level, a close support level, I will be down 50. I'm good with that because I can add more to the position and basically push the price. If the price will turn, I'm now in a great situation, right? So if you don't have a liquidity level, another liquidity level close to you, then you don't need to wait to the full $100. Okay, Julia. Yeah, DL, no doubt. Exactly. In regards to the FOMO, yeah, you will see a change immediately. I can promise you that. I saw it with many of my traders. We used to, in the local prop firm that I worked with, we used to sit about 70 to 100 traders in the same place, trading every single day. And it was amazing to see the shift for the guys that just came in, the new guys that came, and we taught them that, and basically they started to scale in and change the way they work, and it's automatically show the result. So from which time frame do you pick your trend buys? So again, it depends on what you're doing. Are you a swing trader or a day trader? In my case, 1H, an hourly chart, and then I'll go into the 1 minute. Okay, I see that you're a swing. So in your case, it could be a daily or a 4-hour, and then do your trade, like execute your trade from the hourly chart, right? Yes, of course. Marco, it's not, no, it's not $20 that I'm risking. I'm saying it was an example. If you're risking $100, then start with $20 risk. If you're risking 1,000, start with 200. If you're risking 10K, risk 2,000, and so on. So it's not the $20, it's the 20% basically, right? Okay, let's go. Let me see where. Okay, so I uploaded, like I said, I've been doing this 4 months challenge in my my Fiverr's account, our parent company, and basically trading only the Nasdaq. And this is the story basically. So let's talk a little bit about the numbers. We'll actually open the platform as well just to show you, because they got, you know, the triangle that shows exactly where I entered and exit. So you can understand exactly what we talked about today with the scaling in part. So it's from the 1st of September all the way to the end of the year. 100K, 55K in profit, so 55% on that. 5.5 profit factor, a return, 62% success rate. And that's exactly what I talked about when it comes to not actually needing to execute correctly, like looking for the right execution. But since you're giving yourself the opportunity or the trade, the opportunity to evolve, then you will have higher success rate than, I guess, the normal. And yeah, and basically those are the old trades. Each one of them could be, like you say here, on the 26. So those are covers, but basically on the same position. Now, in when it comes to trading, this is CFDs specifically. So when it comes to CFDs, it's not netting account like we have in stocks. When you buy 100 shares of Tesla and another 100 shares, and it will show you one line, right? And basically connect the 100 share and the second 100 share. In netting, in not netting account, edging account, you actually have multiply entries, not combined to one, right? So this is basically it. We can look at some of the nice nice features that we have here. For example, like the hourly. So what hours are more active or better? You can see that, for example, on 2 a.m. comparing to, let's say, 5 a.m., 5 p.m., it's a bit different. You can see also on the weekly time frame, like for some reason, I didn't analyze it yet, but for some reason, Wednesday was horrible for me. But actually Thursday, some Fridays were really great. And I believe we can see, go to an overview and have a look, a nicer view of that. So it started, like I said, the beginning of September. Took me a minute to start, but from there I had a very nice run. Some numbers, interesting numbers here. So you can see biggest loss 546, and I'm actually risking obviously much more than that. But because I cut some of the trades, the losing trades, I cut them before reaching the max few thousand, then it went down to only 546. A profit and loss ratio 3.4 to 1. That's a nice one to get. And like I said, 62% success rate, and yeah, good numbers overall. Let me try to show you the trades. It will be, I guess, more interesting. And if you guys have any questions about them, feel free. Okay. Alrighty. So as you can see, let me. So these are the trades that I made for the last 4 months. This is September, the beginning of September, right? So I'm on a hourly chart. And obviously, like I said, I'm a day trader by nature, I guess. So the thing is, you can see a lot of the movement, the big movements that occurred afterwards or before that. But again, this is my trading. Obviously, it would have been much nicer to hold that short when I entered here and exit here, but this is day trading comparing to holding position longer. But I want to actually zoom in maybe on the last one here, the last trade, and just to show you how it worked. Okay, so you can see that I entered here, taking that short, right? We saw that in a second ago, we saw that chart, the NASDAQ. So I took that short right here. I started building my position. We reached that major resistance level at around 16 something and started to add to the position. Now, because I'm risking not 100 share, I'm risking a couple of thousands, then I can break it down even more than 20%. So I'm scaling in mostly with a 0.2 risk, a lot, and then started to build into the position. Added more as it continued against me, still within the range of what I'm willing to lose, right? Adding more once it reached that moment, it looks pretty good to the downside. I believe the MACD already showed us the diversions and the exhaustion. And basically, in that case, I decided to add more, right? Right now, up until here, I'm risking roughly 60%, 50% out of the risk that I'm willing to lose. When it went against me again and reached a moment going in, you can see it on the 1 minute chart, the volume coming in and many aspects that will, in most cases, will indicate that the price will go down. Adding more to the position, and then I can start execution and looking for that opportunity to close some of it with a loss or some of it with a profit. So it went down nicely. I took a nice profit here, but obviously, as you can see, it continued much more afterwards. And of course, it could have been a crazier trade, but you cannot really expect to hold it all the time. As long as you get what you're looking for, and that's like a 3-to-1 ratio at least, then you can close that trade. And even if it will go against you, continue to your favor without you, you will actually can say thank you because you did your. In that case, you can see my shorts here. I took a short here, added more here, cover some of the losses. And once I saw it breaking through a new high, I covered that. Of course, if I would have held it a little bit more, then it would have dropped and that would have been a profitable trade. But again, if it going against you and I don't have any level above it, then I cannot really stay within that trade because I don't really understand where the next liquidity level that will shift the trade, right? So in that case, I closed it. So, the same happens here, right? I started to short it once I realized it going against me and there is nothing to block it. I decided to cover it. So some trades you will do that. Obviously, others you will have great experience with them. As you can see, I'm either buying, for example, this is a buy the dip, right? So it's dropping to support, major support level. I'm starting to scaling in, adding here because this is the first support, right? This is the first support. So I'm buying here, adding more when it's reaching that moment and added more here. Now that it goes to my favor, I can cover that and so on and so on. Alrighty, that was a quick one. Obviously, we can do many more on those things and try to analyze it and understand even better the way to execute the trade and basically manage the trade. That's the most important element here. Obviously, manage and risk the trade. Yeah, both very important tools. By far, the most important one. It's actually when you think of it, it doesn't really matter which strategy you're using. If you analyze right and you understand that the price should shift or go up or down, now you can start building that position, regardless the name of the strategy. Yeah, you can see it here. Couple of lots in that case, history. Right, so those are executions. So a couple of lots every time. I start with a 0.2, add in a little bit more, 1s, 0.2s, and so on. So this is roughly started with 100, 155. Didn't started to trade this month yet on this account, but obviously I will. Oh, and maybe if we have a few more minutes, yeah, I'll talk about a little bit about that, Tommy. Either mistakes, but generally speaking, for those of you not familiar with us, so we are Trade a Pool. We are an online prop that funds stock traders. So if you trade in stocks or want to trade stocks, we are the place for it. And like I said, the shift in my career was really like the big shift was when I became the head of the traders in a prop firm, in a local prop firm here, because then I started to trade on someone else's money. And once you do that, you don't really care about losing money in a good way, because when we are trading on our capital, like as an individuals, then we always thinking of that loss, right? But if you're trading my capital, you don't really care because you don't know me. So in that case, you're not being emotionally connected to the money, and you can actually make logical decisions. And besides that, we have a risk controller or risk mechanism to control basically the risk or the account from blowing up. So blowing out. So basically, you will have a daily loss and a max loss. You will go through evaluation. Once you pass that, you become funded and actually split the profit with us. David just shared the link here, so you can check us out. We have 14 days free trial, just to give it a test. And definitely listen to, if you want to learn more, regardless of Trade a Pool, but just learn more about trading, go to our funded traders interviews. I'm doing the interviews with all of our funded traders, and they share a lot of the knowledge on how to pass the evaluation easily, but also what they learn from this experience and how to become a better trader. So it's either on YouTube or our website if you go to tradeapool.com. If we have one more minute, David, I'll answer Tommy in regards to the mistakes. So by far the most common mistake is going all in and risking it all without actually building the position. What we talked about today. Because a lot of the guys, when you join us, you go through evaluation, right? You trade a simulator account, you pay for it, you trade a simulator account. And if you pass the evaluation, then we give you funds, real capital to trade with. So on the evaluation, you can see a lot of the traders, because we have like 260K buying power or 160K or even 80K buying power. And a lot of the guys, because they have so much money right now to trade with, and they usually used to trade $3,000, now they have 160. So in that case, most of the traders, not most, but the most common mistake for those traders is basically going all in and risking the full capital that they have now. And this is by far the most common mistake. So just once you understand that and you scale in and you